Hello and welcome back to another week of your Mortgage Market Movers Weekly, where we are detailing everything that's going on in the macroeconomy to help you make better home buying decisions. This week's 30-year fix is sitting at a 6.15, which is slightly down from last week's 6.18. This week we have a good bit of economic data coming out, primarily labor data. So we're going to dive into that and everything else once we get into the charts. So let's go. Really not too much has happened in this past week or so. You know, everyone's come back from the holidays. Not too much is going on for the new year. I believe that rates have gotten a little bit better. And in fact, rates have been dipping down if we look at the 30-year fix, which, that's just the national average, but they have been dipping down. So, this 10-year really, when we look at it, it's been in this range, right? We've talked about this range. There was a point where rates were at the tail end of October, getting a little bit lower with this 10-year sub 4. And now we're at 4.173. But that's really not too much compared to back in May of 2025. Like I said, rates have been coming down. It's just I don't think that they are going to get catastrophically low. Like some people are hoping, right? So the bond market is pretty steady, if we look at this blue line, but we do see it trending down. What we want to see is up, of course, but we do see it trending up. We've seen a little bit of a pullback in the bond market, but nothing really to be concerned about, especially if we just kind of zoom out. Let's see how much we can zoom out. It gets a little funky with this dual chart. Anyway, we can look at the US 10-year and we can see that it has on average been coming down over 25, and hopefully that trend continues in 26. All right, so let's see. All right, now this week we do have a good bit of labor data, so we are really needing to keep an eye on labor and inflation. I think inflation is going to be the key to, lower interest rates. So we really don't want to see that inflation tick up. Even if we see the Fed cut rates, we don't want to see inflation tick up, because when inflation ticks up, bond market participants are going to want higher returns. At least that's my thinking. But that's not to say that it's not important to see what the Fed rates are looking like, and labor is definitely one component of that. So we had manufacturing PMI, and this is relevant, but it's not super relevant to what we look at when we are kind of going over this data, so we're going to gloss by that. We do have JOLTS job openings. We have non-farm employment change, unemployment claims, and then we have unemployment rate, average hourly earnings. So we have a good bit this week, a good bit of labor data to pay attention to. I think consumer credit is something interesting also to look at. Of course, we have building permits and housing starts. And even though they aren't Jerome Powell, it is useful to see what other Fed members are thinking. So I believe, Barkin spoke today at 8 a.m., and it looks like we have more Fed speak when we get towards the end of the week. So on Friday, that can impact the market fairly significantly if they have anything, to say that catches the market off guard. So that is definitely something to look at. Like I said, the 30-year fix, it's just been on a trajectory down. 6.15. So, we talk about how the tail end of October, and this just kind of shows a little bit of the discrepancy whenever we are looking at the 10-year versus the 30-year fix. One, this is an average across the United States. So this might not be reflective of all lenders, right? I believe they get this information from applications. I don't know. Data provided. Oh yeah, the weekly mortgage rate is now based on applications submitted to Freddie Mac from lenders across the country, right? So, that can entail lots of different things. That might not necessarily be what a rate with no points is looking like. So that's just to say that this average isn't the be all end all. It's just kind of one of the metrics that we do use to see on a national average what it's looking like. But there's also a spread of like 1.5% to 2% on the 10-year for investors. And because it is 1.5% to 2%, it just depends really on where you go. The flexibility of some lenders, obviously some lenders have better rates than others, and that's because they're able to work with investors who are able to, have a little leeway on the return on their investment. So their interest rates are a little bit better. But we are seeing these interest rates tick down. And I just don't know if they're going to get too much lower. I hope they do. I just think that we really need to see what inflation's looking like. And it's not always the case that more Fed rate cuts means lower interest rates. It really isn't a straightforward relationship like that. But that's really all that we have for you this week. It was a pretty dang short week, but I hope it was informative. If anyone has any questions relating to mortgages, give us a call at 877-TEAM-MBL or visit us at www.mortgagesbylinda.com. Have a great week.